Welcome to TheoTrade. This is Don Kaufman. November 11th, 2020. The market's rallying back on this Veterans Day holiday. Of course, equity markets are open. The bond markets are closed. Again, Veterans Day, thank you for your service. Let's get to work on this evening's video. There's a few highly detailed points that I want to make that are going to help us through the remainder of this week. All right, so the S&Ps, they finish higher, but one of the first and key points to make here is that the rotations are still very much in play. And by that, I mean, hey, take a look. The S&Ps, all right, they're up by the tune of almost 1%. The NASDAQ is absolutely ripping. The Dow finishes the day almost completely unchanged, and the Russell is also almost completely unchanged. As you start to break it down a little bit further, the rotations that we saw, okay, in some of the recent trading sessions, of course, was, well, quite simply, into financials. Into financials really at any price, at any cost. I mean, we just jumped from 25 up to the 27 handle. Now, I'm going to make this very, very clear. I fully anticipate, again, and I was talking about this in the Monday night video, I fully anticipate, okay, a pullback right to this 2650 level. That is an absolutely critical level inside of the financials and has been literally, people, for years. So a pullback to the 2650 level, okay, highly plausible inside of the financials. But again, before we get ahead of ourselves, the rotation, okay, is still in play. So today you saw the financials back off just a little bit, 0.4%. But at the exact same time, what has been getting killed lately has been the monsters of tech. It's been Microsoft, it's been Apple, okay, specifically Amazon, Facebook, taking big hits. Amazon, okay, big hits in the last couple of trading sessions. And of course, it's a bounce back. So this, again, this rotation is still in play. And also with that rotation, of course, you'd have to look at the energy sector. The energy sector was being bought pretty much at any price yesterday, backing off mildly by the tune of about 1%. Again, wild rotations here. Boeing, I think Boeing is a great point to be made. Jumps to the upside, backs off a little bit today. Everything they wanted to buy, they're selling. Everything they wanted to sell, now they're buying it. That's the rotation, okay, in play. All right. In a much larger sense, though, okay, the correlation of the marketplace, well, first and foremost, yeah, again, you have to look at the S&P 100. I was talking about this again on Monday because you had a day where the S&P 100 also did not see higher degrees of correlation. For those of you that don't necessarily speak geek, okay, correlation is critical for markets to move, okay, outside of, for instance, ranges. Right now, what are we doing? Again, it's a rotation, everybody all of a sudden into the financials boat, everybody out of the financials boat, back into technology. This, okay, is not correlation. Correlation to the upside. When I say to the upside, in terms of a rally, you'd see like 85 stocks actually, to the upside, maybe 15 to the downside. Again, that's the S&P 100. But the one key point to be made about correlation here, right, is again, there's still lack thereof. And you're looking at this, and if you're objective, you're like, well, did the market really go up? Everybody's like, well, of course it went up. The S&Ps, sir, were up. Yeah, but the Russell went absolutely nowhere. The Dow went absolutely nowhere today. You did have the dollar rally a little bit. Again, dogs and cats living together. This is a veritable slop fest. And I don't look at it so much as a rally as I do, just kind of that reverse rotation. Correlation in the coming days is thy enemy. Because if we start to correlate, this marketplace has the propensity to move huge. And that's one of the things that you don't just have to think about. It has to be at the forefront of everything you're doing. If we open tomorrow, even if there's 100 stocks trading to the upside, that is not necessarily a good thing for the marketplace. You're like, what? It's 100 stocks to the upside. No. It's correlation. Once the correlation coefficient kicks back in, the marketplace would be capable of virtually anything. A rally with a huge fade over here, but correlation is nowhere to be found, okay, in recent trading sessions. So you had a little bit of the reflation trade, huge sector rotations, but there just isn't any correlation. And I'm telling you, at the cash opens, people focus on this. Don't even bother with the S&P 100, or I should say 500. I look at the S&P 100 because reality, even out of the S&P 100, there's only 50 products that really even matter in here, the usual suspects and so forth. But correlation is everything because that, okay, is what not just moves markets, but moves markets outside of ranges. And if you're not familiar with this right now, again, if we're going to break to the upside, you got to have a correlation coefficient that's going to be extraordinarily high. You're going to have 85 stocks to the upside, 90 stocks to the upside. And that, again, is kind of a critical point. But even if we correlate to the upside, it also gives us higher probabilities throughout the course of the day of seeing wicked reversals. So onward and upward. So we had ultimately rotations that are still in play today. Okay. We have correlations that are nowhere to be found, but correlations, of course, going to be the enemy, right? In the very near future, it's going to get wild if we correlate because we're just going to move huge. All right. Third point to be made over here, volatility. Okay, is still very much a cautionary tale. Now, when people look at volatility, they have this infatuation with the VIX. And right now, to be quite frank with you, I'm fine if you want to look at the VIX. The VIX is just back to where it was, and not even quite down as low as it was, back to where it was, portions of the summer. But the interesting kind of notion that goes with this, okay, the VIX is right back down here to the 23 handle, but we're still seeing fairly large moves. Why did I say, don't worry so much about the VIX? I'll tell you why not to worry about the VIX. What concerns me more is the VIX of the VIX. This is the volatility of the volatility index, which has been on the bid, okay, the last 3 trading sessions. Somebody believes that they need to hedge risk. And all of a sudden, the VVIX, again, the volatility of the volatility index, soars back almost to the 120 handle. Now, this is a volatile product unto itself, but this thing was trading, all the way down to the 105 level. This thing soars back to the upside. And when I say this is a cautionary tale, you have to take it as just that, okay? This is a little bit of a shot being fired across the bow. Now, with the fact that the volatility index is rallying back, you've also got the dollar on the bid a little bit. That's also a little bit of caution in here because the last time, and we saw some sell side activity, of course, the dollar was ripping when we saw that sell side activity. So we have the dollar coming up. We also have the VVIX coming to the upside. Now, of course, you're going to ask me to read into bonds. But as I said, it's Veterans Day. It's Veterans Day and the bond market is closed. There is not much volume in the bond market. But I'll say this, in terms of a bond holiday, the electronic bond market, which is the ZB, the ZN, right? Those products are still open, and I was almost shocked how much volume they did do. I mean, the ZN, it's still traded. Again, and this is with the cash bond markets are effectively closed, but the ZB and the ZN did some pretty good size in here. Nevertheless, you still can't read into this too deeply. You just can't because, these bond futures in comparison to like cash bond markets, these are just, minuscule and compared to the some of the bigger products that trade there, which were effectively closed, okay, during today's trading session. Again, observance of Veterans Day. So rotation still in play, volatility coming up, correlation nowhere to be found, okay. The last point to be made over here is related a lot to some of the volatility. And it has a lot to do with, you look at things like Microsoft, and I don't want to, detail every single position in here, but you look at something like Microsoft, and what I'm pulling up is an implied volatility, it says range. What that range that I'm really pulling up is, okay, I'm actually looking at the IV percentile, or better known as an IV rank. And just the point that I want to make with implied volatility right here, right now, is this. The implied volatility has come off. The IV rank has come off considerably in something like Microsoft. But those shares, they are still moving, okay? I mean, everything in there, the actual price movement inside of Microsoft, okay, is huge. It's not just in Microsoft. So I bought premium today, and I bought premium in places like Caterpillar. Why did I buy premium in places like Caterpillar? Take a look at the implied volatility rank all the way down to the 15th percentile with still wicked movement capable. I mean, let's push aside the IV rank for just a second and exploit the fact that Caterpillar is sitting at or near all-time highs. I don't care whether you're bullish or bearish. Again, I bought both sides of this. I actually bought what we term a gamma iron. If Caterpillar decides to explode to the upside and go for all-time highs once again, we're going to be there. We're going to be profitable. Caterpillar actually dives down anytime in about the next 37 trading days, we're going to be gold. It's not just Caterpillar. Another one I actually went out and grabbed some premium in Goldman Sachs. If you take a look at Goldman Sachs, very, very similar in respect to the IV ranking. The IV rank here is all the way down to the 11th percentile. Now tell me, okay, is there still volatility in this marketplace? Yeah, but it's to the upside, right? You got some upside volatility, and I just can't stress enough. I don't know, okay, if these financials are going to break back to the downside. Again, I have anticipation that the XLF is probably going to come back down to the 2650 level. But here in Goldman Sachs, again, if this thing were to explode back higher, doesn't matter. I'm going to be there buying iron condors right now. Again, being a buyer of iron condors in a number of products from Goldman Sachs and so forth. And, we even checked out like Boeing, even Boeing. The IV ranking is incredibly low for the types of moves that we're seeing in here. Listen, this marketplace, okay, just a huge reminder here, it is still the beast. There is still a tremendous amount of volatility. You don't have to look too far, okay, to recognize the fact that here, this is the SPX. These are the expected moves. We exploded higher on Monday, pulled back, touched right back to the center point, blew back to the upside. The upper edge of the expected move is 3,600, and you still got 2 days left to trade, okay? Keep your wits about you. Keep your risk in check. Volatility is far from over. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.